everyone. I think it's great to be here. This is going to be a panel on valuations, comparing Web 2 versus Web 3. I'm Suri. I'm a second-year MBA at Wharton, and been doing some stuff around crossover funds. Used to do some early-stage investing before. We have a great panel here. I will briefly introduce all of them, and feel free to also jump in. So we have Mike, who is a general partner. He's a general partner at Galaxy and focuses on an intersection of crypto and financial services, software infrastructure, dev tools. He's been investing in crypto since early 2017. Was at Bessemer before, where he led the crypto and fintech investing efforts, investing in over 30 companies across stages, and was at IVP before that, where he led the investment into Coinbase. And he started his career at JP Morgan and was business development at Circle. Great to have you here.
Thank you.
And so we have Jason, who is a investor, VP at Sapphire Ventures. It's an enterprise VC making investments in software businesses at the growth and expansion stage. Jason covers blockchain, fintech, and has been involved in the space for a while. And he's excited about applications around smart contracts to financial services specifically. And he used to be advising global fintech firms before Sapphire. Thank you for joining us here. Yeah. And we have Sylvester, who's a founding partner at Sentinel Global. It's a tech VC focused on blockchain-based innovations. He was the co-founder and CEO of a fintech company before. His MBA at HBS. Prior to that, he was at GIC, Singapore's sovereign wealth fund, and was the Singapore military before that. And it's fantastic to have you join us. And we have Lindsay here, who is an investor at Bessemer. And where she leads the crypto investing efforts out of the San Francisco office. And she's focused on early stage opportunities across consumer crypto. And she's also a Wharton School alum, so it's exciting to always have alums over. And we have Josh here, and Josh Feiner is a investor at Solana Ventures. He primarily focuses on earlier stage companies, and he's a true regent, been involved in the space for a long time. And he insists that you should be asking him about what Solana NFTs to ape into. So there you go. So no, it's. I think the panel itself. I think the topic is something that's I guess very important, just given where we stand in terms of the market today. Particularly after FTX and all the macro headwinds. So maybe we just start with understanding where crypto stands in the context of broader venture markets today, and also what are investors actually factoring into valuations today. So maybe we start with you, Jason.
Yeah, let me see. Okay, that's perfect. Just check if it's working. Yeah, I think it's an interesting dynamic where, especially when you're considering like token versus equity and where those marry together in some of these businesses. I think over the last few years you've seen, and in light of recent market events, quite a bit of maturation, both on the investor as well as founder side of how investments are being structured. I think, and colleagues here will probably be able to speak better to at the seed stage level, but I think it's very similar to any seed stage founder where you're designing a business model. Often you don't know how you're going to monetize, what revenue looks like, what will kind of be a repeatable sales cycle. And I think preserving that optionality is even more important in crypto, particularly where you might not have an understanding of whether value will accrue at equity or token level. And so I think that's where you start to see things emerge, like equity plus token warrants become like such a common structure. And being able to have just flexibility and optionality in the business model. So I think that's been something I've seen quite a bit recently, with just companies we've been investing in and looking at. I'll probably pause there, see if others have kind of other takes. And admittedly spend more time on the growth expansion stage. So I'm sure like some of the seed stage folks will have a more point of view than I do.
Yeah, happy to go next. So I think just kind of stepping back a little bit, we've seen the crypto venture markets and crypto markets more broadly sort of mirror what's happening in the broader technology venture markets, right? So you have on one hand, if you look back, 3 to 5 years ago, we've seen a lot of technical innovation that's happened since then, which is really positive in terms of kind of the development of NFTs and DeFi and the merge and things that, scalability, stablecoins, things that that were still open items, open questions just at the beginning of the last cycle. And we've made a lot of progress since then. That is the technological wave has been quite positive. The valuation wave on the other end has been very very up and down, to say the least. But this is not a crypto-specific problem. It's a risk asset phenomenon. We're seeing it across tech stocks and really across public token valuations, private investments of all natures, right? So that is sort of where we're at with multiple waves kind of colliding at the same time. I think it creates a very interesting inflection point for our industry specifically around companies that have raised at high prices and need to figure out how to fund the business going forward. New founders who need kind of points of reference to raise their first or second round of capital, that relying on old data that was just a few years, even a year ago, is totally out of context today. And so I think maybe we'll get into this a little bit deeper, but just kind of a reframing of the valuation world, I think, is a really important topic that can make or break companies, right? It's how they raise capital, how they fund themselves from inception to ultimate exit, whatever that looks like, is a critical piece of the formula here.
Yeah, so maybe I'll just add a little to that. So I think the last couple of years was great learning for any emerging industry, as we all saw it. And I think what we can agree is not every single project needs a token, right? So over time, we are all very familiar with pure equity models, pure token models, because we see, but as Jason put it, across time, you've seen a hybrid kind of setup. You have equity plus token warrants, for that matter. And the reason why people are still not as familiar with how to deal with it, because they sit at different parts of the stack too, right? In equity, where you invest in a company, you sit under the equity portion of the balance sheet, whereas if you take into account a utility token, for that matter, because it's a promise to a future service or product, you kind of sit on the liability side, right? Because the company actually promises you something of future value in it. But if done correctly, this hybrid model actually could compound a lot of value, right? Because there are merits on both sides. So for the equity side, you get investor protections, you have some governance structures, but on the token side, if done correctly, if released at the right time and is tied to real-world utility, it actually unlocks liquidity for a lot of folks, right? And people can participate in the ecosystem. People who want out can get out too. So I think the key is whether the tokens are released at the right time and whether they are tied to real-world utility. And all those whom we've seen that it's just pure speculation have definitely ceased to exist, a lot of them. So I think that's what we see on our end.
First of all, the mic's not on. First of all, I don't know if you guys caught in the background, but Mike actually was at Bessemer prior to being at Galaxy. And in fact, not only was he previously at Bessemer, I think we started on the same day before he left to do bigger and better things. So he'll keep me honest as to whether or not I'm doing justice to how Bessemer thinks about the current markets and valuation. But to take, I agree with a lot of what folks have said already. I would take an even bigger step back and say that the way that we think about valuations is actually decoupled too from the kind of recessionary environment that we're in. Obviously, those two variables play onto one another, but I think in 2001, 2002, we saw true kind of like valuation crash, and then in '08 we saw a recession, and right now we're seeing both. And what that means for us is that on the recession side of things, that also plays a big role in how companies should be thinking about cash management and what the fundraising environment looks like for the next 18 to 24 months. And then that's also playing into the valuations that they'll be receiving should they be lucky enough to get funding in this environment. So I would make that distinction clear, even though those two variables, again, like play very closely onto one another. The second thing I'll say about the crypto markets, I mean, I spend all my time in early stage, so mostly seed and Series A, which is a little bit of like, finger in the wind type of thing. But I also think a huge part of it for us is thinking through, I think the analogy of crypto to the internet is good, but it's a bit trite. And so what I mean by that is it's right in that, to Mike's point, there's been tons of technological innovation. There's been much more connectivity to, if you use wallets and developers as a proxy for consumer and dev interest. Certainly, this looks a lot better than it did in the last cycle in 2018. At the same time, when you compare 2001 internet usage to 1996 internet usage, those numbers kind of largely dwarf what's happening in crypto today. So I think two takeaways from this. One is we are still looking for, and I think Sudi will ask some of these questions, what is that unlock in terms of use case? And two is it's highly possible that crypto is a really niche and really valuable sector within tech. And it doesn't need to get to quote unquote mainstream adoption to be super valuable. I think either of those things could be true, and both of them panning out makes it an interesting investment opportunity and interesting investment sector.
I have very similar takeaways as Mike and Lindsay. It was really interesting to see the valuations go from second half of 21 to first half of 22, where valuations got insanely bloated. Felt very decoupled from what traditional markets were. Obviously, there's plenty of other macro things to consider with monetary policy, but valuations escalated very highly. Starting in second quarter of 22, started to kind of stabilize, then plenty of headwinds came in the way. FTX, then even further into the year, then you start having some funds that have redemptions, tax loss harvesting. There was just very limited activity, I'd say, in Q4 of last year because there was so much uncertainty to underwrite to. I think already this year we're starting to see some recovery. Valuations have certainly reset from the prior year. But it's really fascinating looking at valuations of crypto in total to what traditional tech companies are. They're still higher than if you, for instance, you look at like a seed traditional tech startup, you might get $10 million seed round. Do we ever see that in crypto? Maybe, sometimes. But most of the time in seed, at least at Solana, we see ranges from 15 to 25. I know ETH is likely a lot higher than that. So it's really interesting, like the progression over the past 2 years of the fluctuation of valuations and this period in current bear market, you could say, of them kind of stabilizing at a more reasonable price. Reasonable, obviously, is kind of an arbitrary statement. But it's going to be interesting over the next year, kind of where valuations shake out, and then we'll obviously get into the discussion of kind of tokens and equity and how that prices into valuations as well.
Can I just pick up on something that you said, which is this crypto premium, right? Is something I think a lot about, and we at Bessemer we think a lot about too. When I was there, which is like for a lot of firms who don't just focus on crypto, they're looking at a whole range of types of investment opportunities. And when you're looking at seed deals at 10 posts and then 30 posts, you say, what are we missing here, right? And it sort of just begs the question, should crypto have a premium? Should it have a discount relative to other things, right? Like we're so nascent, and the industry is so nascent, the technology is so nascent in a lot of ways. Yes, it can disrupt, like there are arguments on both sides, right? Like there's a lot of technical risk, there's a lot of market and adoption risk. On the other side, maybe the markets can be substantially larger. We're talking about disrupting money and the internet and like some of these big concepts, although very kind of off in the distance and sort of murky, when you think about that disruption over a long period of time, maybe it does capture the majority of that value. So it's something I think a lot about. I don't have a great answer for why it should be a premium or a discount. I do think we are seeing a shift back toward traditional non-crypto valuations. I hope that continues. I think that is actually healthier for the space to evolve over a long period of time. But it's just something that I think founders and investors should continuously think through.
I think those are great points. I think particularly, maybe it's a segue to thinking about, this whole Web 2, Web 3 convergence around multiples. I mean, often you see kind of, something like a Uniswap being compared to, say, an ICE in terms of, price to sales multiples, or, NFT marketplaces being compared to other marketplaces, or Ethereum to databases and so on. So, I mean, maybe just staying on that same point, is it fair to expect that these multiples should converge? And would also love to get the broader panel's opinions. In terms of, are these, because, if you look at Uniswap, for example, there's the whole fee switch, and fees don't necessarily, accrue to the token holders. There's the whole liquidity pool provider issue as well. So, is true convergence meaningful? And maybe let's just stay on applications and not on the layer 1, layer 2. Would love to get thoughts and just like a deep dive.
I thought about this question a lot. It's interesting because the concept of multiples converging to like what we see in Web 2 or traditional businesses, there's so many factors you have to consider. One, the maturity of the industry and kind of the growth multiple that's applied. So traditional marketplaces, I don't know off the top of my head, but what multiple they're trading at, but crypto undoubtedly has a higher one. You also have to think about like the composition of these businesses, where a traditional marketplace or a traditional platform, what do they need to hire for? What are their expenses? What's like the entire composition of like when you look at their income statement that they have to pay down for to get like an earnings per share? Crypto is kind of different, or not kind of, is very different. A lot of it is software, open source that people can leverage. So when you look at like a marketplace like OpenSea and the amount of volume they're doing, and think about what a business like that would be in the traditional business world, I mean, it's entirely different expense structure. So I don't know if you can say that multiples will be similar, but you may see them converge in terms of comparison to other kinds of businesses that look like traditional businesses that warrant higher multiples. It's kind of a tough subject because there's so much more maturity that needs to happen before I think they even get close to traditional businesses.
So maybe I'll just add on to that, because crypto is so broad, right? I think people often associate crypto to cryptocurrencies, but blockchain as a whole is actually very broad. And so I would say that there will be convergence in certain parts of the blockchain world, but there wouldn't be convergence in other parts. And I mean, for good reason. So the convergence that you'll see is businesses that people tend to understand. So you're talking about the likes of like SaaS-based companies. The business models people know, recurring revenues. You have the likes of Chainalysis, TRM, TechSpit, where they charge an annual subscription and people can value it accordingly. So if you look at the public markets, the SaaS-based companies have moderated to about 8 times forward revenue. You're already seeing that impact across the board, like on Chainalysis and so on. The secondary markets and so on are kind of figuring out, all right, this mirrors some of the high growth SaaS companies out there. But on other aspects of blockchain, I think it's kind of hard because of the unique structures in place, the structures, whether it's on the governance and the likes of that. Like you rightly pointed out, Uniswap. Right? Uniswap is kind of tricky because all the fees go to the liquidity providers right now. But the token holders have that option that they can switch on the fee switch, that they accrue some to them. And now it's further more complicated because now you have Uniswap Labs, where you have the equity holders, where it's like on the parent company that actually one of the products is the Uniswap, right? So then if you go and read into it, there are tensions between different shareholders, whether it's on the equity side, the token side, because if you switch on the switch, yes, the the token holders get some fees, but would it impact the whole ecosystem because liquidity providers leave the system, et cetera? So it's different considerations. So on that side, what is its comparison to the Web2 world? I don't think there is a direct comparison.
That's very fair.
Yeah, I think just to add on too, one thing I think about a lot is just the immaturity of the space and how that translates to the public markets. So one of the things that's I think is super hard is you look at the number of public companies today that operate in the blockchain space. It's one or two exchanges, Coinbase most notably, a number of like hardware mining companies, but just becomes really difficult to then, especially for later stage investors that come in to try to evaluate these business models and mark those up. And even public market investors are very new in understanding some of these business models. Even things like staking, yield generation mechanisms are like very hard to link back to reoccurring business models that they might see in fintech or financial software. I think it's like time as public market investors start to appreciate these business models more and understand the revenue composition better. And I totally agree about a number of nuances with some of the various business models. Like a great example in consumer fintech, like really hard to make like a neobank or a store of value proposition work unless you reach incredible scale and the economics start to turn. Whereas like with a crypto wallet, you can have a small engaged user base of 50,000 highly engaged users that are actively using multiple components. It could be DeFi, yield generation, staking, more complex swap mechanisms, and becomes like a really lucrative way to monetize off a small user base. So I think like time comes, you'll start to see, and I think as Mike referenced earlier, we're also in just such a strong level of dislocation in just the TradFi and Web2 spaces of multiples right now. So I think trying to map that back to how that'll impact crypto investments is just very challenging.
I really like all the points made. My kind of summary of this question is, because we're so young and we're experimenting with so many different unique structures, there isn't really a basis to do intrinsic valuation analysis, right? And so Josh talked about understanding the cost structures and there's a lot of, the growth potential, the market sizes. It's really hard to do bottoms up intrinsic value, DCF, type analyses. And so therefore, when you're valuing company project A, you look at project B that is similar in the crypto market, and a lot of investors try to apply that multiple. And so you find a self-referencing valuation methodology, and that creates larger dislocations. In valuations, right? Because you're pegging off of something that may be dramatically mispriced and applying that to a new project that you're evaluating. So this is, to me, the crux of why there's such a large dislocation. This will get refined over a period of time as structures become more clear and standardized, as valuation methodologies become more clear and standardized.
But just staying on that point, how are you de-risking such dislocations from happening when you're kind of looking at projects when you're valuing them?
So to Sylvester's point, the types of business models that, if there are comparables, right, that are outside of the crypto world, it helps us say, in 5 to 10 years from today, how does this marketplace business model, how will that trade? And you can look at the public markets and you can see these multiples trade at 3 to 5 times, or now probably closer to 1 to 3 times. And for us, it's how fast does this company or project need to grow in order to offset the multiple compression, right? Because if you're getting in at 50 and it's going to trade at 5. Yep. You're as an investor, you're experiencing 90% roughly multiple compression, right? And so the only thing that offsets that in order to generate, to drive returns is growth and efficient growth, right? So you have to believe in the market size, that company's ability to capture a large portion of the market, and the business model, right? In order to monetize that opportunity, all of those things sort of play into how we would rationalize and underwrite the growth for a given project.
Yeah, Lindsay.
Yeah, the last thing I'd add is the phenomenon that we experienced with the last bull run is that most of the funds that made money in crypto within those, I don't know, call it 2 to 3 years, experience liquidity via tokens, right? And so I do think I think we've experienced a strong swing away from that. But I also don't think that we'll necessarily get to the point where in the next upcycle that crypto companies will exit in traditional ways. And so I think finding what that middle ground is will be really important, and then also answer some of these questions about maturity and fund returns. And so, I think that's something that is, we just didn't have a chance to touch on, that I would highlight. And I think at the end of the day, when some of these crypto native funds go and look at their returns, unfortunately, a lot of their top returners are actually no longer, kind of existing projects. I think it's great to make returns for your LP in any way, but for us, I think it's looking for how do we think about generational companies that create long-lasting value for users, and that at the end of the day is what is motivating our investment decisions.
I think just staying on that point and maybe steering away from applications to thinking about layer ones and layer twos. I think it's at that point when you start to see valuations or whatever you peg it to, protocol revenues, etc., and multiples look astronomical, 1000x and higher than that, and super unhinged at that point. But how do you think about valuations at all, or how much do you pay for a layer one or a layer two, and what goes into the thought process around that, and how do you think about pricing power with respect to layer one, layer two fees? Just curious if there are any additional comments on that front.
So at Solana Ventures, we don't invest across any other L1s, L2s, but we do I personally have a viewpoint of protocol fees as a method for valuing an L1 or L2 feels insanely premature. I think there's so many mechanisms in which a layer one or layer two can adjust what's being imputed in their valuation. I mean, Mike, I love the point you made, because DCF is essentially the way that people end up backing into multiples. You use multiples as a way to compare across different business models, but in actuality, you value something based off of the free cash flow they kick off, discounted at a WACC or a discount rate, and push that out into a terminal value. So thinking about protocol revenues is a very simplistic way right now to say, yes, ETH generates this amount of protocol fees, we'll slap a multiple on that, and that's how much ETH should be valued at. There's so much more that goes into an L1 or an L2. I have to credit Multicoin. They laid out a summation of the parts valuation methodology. I haven't actually seen it used in practice, but it's really interesting to look at layer one or layer two blockchain tokens being valued this way. So it can be bucketed into 3 different asset types: a capital asset, a commodity asset, and a money asset. Capital asset, indirect cash flows through something like MEV. So that's kind of the free cash flow. Commodity asset being you use the underlying token as a way to transact. So that's kind of like the ETH model, right? They also have MEV, right? But that's the ETH model that's pushing a bunch of protocol fees right now. Solana has it. It's very low fees because we're optimizing for user performance. There's a bunch of other design trade-offs there. And then the last one is a money asset, like the store of value, unit of account, collateral. So valuing a layer one or layer two blockchain under that thesis, I think gets you to a way different perspective than just looking at fee revenue based off of how it's being looked at right now.
To add to Josh's point, I think for value, usually there'll be a portion that would be attributed to fundamentals utility, and then there'll always be a portion that will be attributed to some form of speculation of the future potential of whether you're talking about protocol or a company, right? So every layer would come out saying that they want to be better, faster, cheaper, safer, more scalable, and everybody will try to push for different competitive edges. And that's why, to Josh's point, if you just look at protocol revenue, it could potentially be very misleading, because if say a layer becomes more scalable, more cost efficient, cost decreases, right, in terms of the price. But then activity rises significantly. So you could have an instance where protocol revenue is constant, but the makeup of it is very different, right? You have significantly increased activity, but way lower cost because they've figured certain things out. So to Josh's point, you need to look at other factors that make up, whether it's the network itself, the activity that's going on, because that one figure alone doesn't say a lot of things. And the same goes for some of the multiples out there. A lot of people love to use price to sales because nothing is profitable. A lot of things are not profitable yet. I wouldn't say nothing, but a lot of things are not profitable yet. That's why it's very easy to just use it as a form of safety. But it doesn't give you the profile of, like the potential margins, the growth profile of it, even, on the balance sheet, the capital structures and the likes of that. So as an investor, you need to look beyond that, I think, which adds to Josh's point.
By the way, Josh, 40% of the Wharton students in here didn't start listening until you said you need a discount using WAC.
I mean, there's supposed to be some Wharton finance folks here as well, so hopefully that's not the case.
Yeah, I'll just add one additional comment, which is on top of the kind of layers of value that we're talking about, whether it's fundamental value, this sort of like the network value, the kind of different components. The other hard to quantify level of value is the scarcity value of a given asset, right? And so if you look at where ETH is trading, or let's just take ETH as an example, with hundreds of billions of dollars of network value, the battle for the high throughput, low latency, low cost alt chain, that battle has not been settled, right? Like we're still very early in that progression, and the reward for whoever wins that race is could be in the hundreds of billions of dollars worth, right? So could be much more over time, and so it's there aren't hundreds and hundreds or thousands of teams who have the expertise to try to execute on that, and so there is a lot of scarcity value, and coupled with a really big prize at the end of the rainbow for the teams like Solana and others who can be that alternative.
And I don't know if I'm attempting to suggest a different valuation model when I say this, but some other important features aside from protocol fees, you can look at daily active users, transacting users on chain. You can look at throughput, total transactions that occur on a chain over a period of time, because those are more emblematic of actual use and value people are deriving of interacting. Fees can always be changed, right? Like that's a very strong argument. Any chain could be like, let's bump this up, like 1 percentage point or elevate it. So it's a very dynamic field versus looking at things about a chain that have illustrated some sort of product market fit or something where people are like, actually this chain seems really optimized for this single purpose, and start to extrapolate out from that versus the fee model, but I've already beat that to death.
I think one thing that's been interesting, and obviously these are all metrics that become incredibly relevant once you've hit mainnet and you have dApps deployed and there's like actual launch, but I think a lot about is just like these growth stage rounds, hundreds of $1 million investments, valuing these businesses at billions of dollars when it's like a pre-mainnet launch. And so it's essentially a seed stage business risk at like a growth stage price. And so that's one thing we always try to reconcile at Sapphire, is just getting a sense of how do you value these businesses, and there's like not actual tangible metrics or projects deployed or a sense of like protocol fees and revenue to go by. And I think like one component it comes back to, and I think you'll still continue to see these really pricey L1, L2 rounds done, is just the nature of tokens. I think equity is really interesting in that. Very easy to understand as the business accrues revenues over time, equity like increases as a result, whether that's based on like a next 12-month revenue or EBITDA multiple. But tokens have like can reach mature, like have the ability to a liquidity event much earlier, but also reach maturity much quicker. And so you might have like an initial price pop, like kind of might settle. There can be eventual like updates that might happen, or it like even memes or narrative driven that results in changes or fluctuations. But getting access to those, it's why still like growth stage investors will pay a premium to get access pre-launch at a discount with kind of that notion in mind. So that's something I don't know if I have an answer for it, but something I just
this is all very interesting. Yeah, and I think it does seem like it's fairly early days in terms of like figuring out the right framework in terms of valuing these L1, L2s, and clearly protocol fees is not the only one to be thinking about. It's clear. But tagging along to your point, Jason, when you think about tokens and valuation of these tokens itself, how much? I mean, what? There's the whole value accrual to the token, and this kind of touches upon points that were made earlier. What are you kind of telling your investee companies today that are thinking about token launches, launch, or are thinking about it in terms of value accrual to the token itself, so that they may fare well once they go public, effectively? And in terms of the sort of what's the pre-launch checklist that founders keep in mind when they go about that? And also, maybe just a part two to that question is, how much is like voting rights important in this whole process? Is that something that venture funds think about? Is that valuable? And is that being priced into the valuation somehow for the token itself?
I'm going to chat about the governance piece quickly, just because something I think is interesting. It feels very early innings for thinking through governance. I actually think a genius career would be to specialize in governance now, and I think 3 to 4 years would be an incredible asset to have. But I mean, it's like in light of recent events, right? There was the recent Uniswap vote for like supporting BNB via wormhole, and it was kind of a community proposal. It looked like it was going to go through, and then A16Z stepped in and kind of blocked the vote, citing a preference for using layer 0 over wormhole. So like an interesting use case where a venture capital firm has a sizable enough allocation that they can influence kind of the direction. I think, as mentioned before, like very early innings to see how governance is structured and take shape. It's like a big experiment, it seems like, at this point. But you start to see some like really innovative things coming out. Optimism has this bicameral House approach that almost mirrors the way our government is structured, with like its token and citizen House, and trying to use that to streamline how token like protocol profits are being used. So I think that's like, it's super going to be like interesting, and I think how venture investors participate, whether that's delegating to institutions like Penn, nonprofits and others to vote on their behalf and help to like decentralize and diversify the owner base, or whether like others like USV do a great job actively participating and helping to shape like protocol direction and development. So the governance piece I'm super interested in. I actually would be open up to folks who have a view on how that translates to actual valuation.
Yeah, there are certain things on the governance piece, the voting rights, that you can see in the two worlds, whether it's Web 2 or Web 3, they're converging in terms of some of their dynamics, meaning that it will start off with everybody being excited to vote about everything, whether it's DAOs, I get to even decide what merchandise this company is going to give at ETH Denver kind of thing. But very quickly, you'll see that people start delegating, right? And then what ends up happening is you have just these few entities voting all the time. This is like when you have a normal shareholding in equity world, right? And research has done, there are research out there to value like shares with voting rights and shares without voting rights. And across time, the difference between the two is between 0 to 10%, depending on the dynamics between that, right? And voting rights also differ in terms of how valuable they are. If you have a very strong management, you don't really need to worry about them at all. Voting rights, actually, yes, you vote on the executive compensation and the likes of that. But if you have a bad management, the voting rights become very valuable because you get to dictate and you can turn things around, right? And then there are things also like the voting concentration, right? I think Jason rightly pointed out there are certain instances where it's super concentrated. And if it's super concentrated, you having even a say doesn't even matter at all because you are not going to change anything, right? It's all concerned. And the last one is back to the Uniswap example, the complexity of the arrangements involved. Sometimes even if you have a vote, but there are other considerations in place. So that's on the governance piece.
Yeah, so I think we have another couple of minutes left. Maybe just as it could be like just a rapid fire, maybe in terms of what you're all most excited about in terms of, themes, in terms of deploying over the next sort of, 6 months, year. What are you most excited about? But just make it a very quick pass through.
Sure, I'll kick us off. There are a ton of really strong founders and companies launching on Solana right now. I think some of the features of the Solana blockchain lend really well to use cases of payments, gaming, DeFi, where low latency and really strong user experience, being able to interact on a monolithic blockchain and not have to swap and bridge or worry about whether a transaction was confirmed after 5 to 10 minutes, that all improves the user experience a tremendous amount. So really thinking what products can hit mainstream feel like a main target for Solana right now.
Yeah, I would say on the consumer side of things, I spent a lot of time with the Shopify team. We were early investors there, still on the board, and I catch up with their BD team a lot, thinking through what merchants are looking for, especially how do they envelop some of that into the Shopify Plus offering. A lot of folks are thinking through, loyalty is an obvious use case, however, hasn't actually gotten a lot of adoption in the Shopify App Store, interestingly enough, and thinking through how do you create a tighter loop between consumer and brand that's not just email and SMS. I also think consumer generally, we think a lot about, not like, I think everybody's been on this bandwagon of Web3 needs better UX, but if you think about a lot of the early internet companies, eBay had the worst UX, and people were still using it in spite of it crashing and breaking constantly. And their GMV numbers continued to accelerate despite this. And so we're looking for that kind of magic where it's a 10x better user experience, it's a 10x better consumer experience, even if that user experience isn't completely there yet. On the infrastructure side of things, I've been spending a lot of time in authentication. There is general consensus that MPC, multi-party computation, is kind of the next iteration of self-custody. I don't know what that looks like in relation to account abstraction, which is another hot topic right now in crypto. And so thinking through, I think Auth0 for Web3 is, again, kind of too trite of an analogy, but in that realm of how do we make self-custody better, easier, more secure for users.
So on our end at Sentinel Global, our whole thesis revolves around the institutionalization and commercialization of blockchain. So I think some of whatever Lindsay has pointed out, whether it's on the security side, whether it's on the authentication, naturally falls within. So compliance, analytics, trust, multi-party computations, and the likes of that. Another big area that we're focusing on is zero-knowledge proofs too, because I think this, as a technology, is going to be revolutionary on the scaling side, and also the ability for you to segment your personal from transactional data. But in what shape or form does it play out? We're still trying to figure out, right? What's investable, what's not? Because as a technology, it's interesting, but what's investable might differ from that. And the last one is anything that provides institutionalized access, whether it's to DeFi or some other realms.
Yeah, I spent a lot of time thinking about institutional adoption and bringing kind of tokenized assets on chain. I think a key KPI for DeFi in general is the number and different types of assets being brought on chain. I think security is probably to me personally the area I'm most passionate about. I think the lesson that I hope we've all learned throughout this cycle is while decentralized finance and other crypto primitives are potentially disruptive, cutting edge, they also have a lot of properties that make them more susceptible to exploits and hacks beyond outright fraud, right? Like technical risk, economic risk. And these systems need to be designed and maintained in a way that protects users, protocol designers, investors, institutions, corporations. I really think it's going to be challenging to convince a variety of different constituents to come into the crypto world unless we can protect their assets.
Stable stakes, yeah.
Yeah, and I think just like similar themes that folks have mentioned, Sapphire, we really enterprise software focused investors. I've done a lot in the developer security tooling space and quite a bit in fintech and financial software. So think a lot about like those bridges of what takes to build scalable, secure, compliant infrastructure to onboard traditional financial institutions into CeFi and DeFi. What's needed to abstract complexity to bring Web2 developers into Web3. A lot of that, I think, security similarly, whether that's like in the transaction flow or even just helping developers to bring their CI/CD pipelines and tools that they're familiar with into Web3 so you can build applications in a more performant manner. And just payments, I think, is I'm super excited about. You've even been chatting with, like, I think the other week, connected with like a FX cross-border transfer network operating in like the Africa, sub-Saharan Africa and West Africa. And almost like 20% of originating and receive and end market volumes were going through stable coins. So I think that's going to be in what was I think almost 7 trillion I think almost last year in transactions. A lot of it in and out of exchanges and stablecoin volume. But if the last bear cycle was how do we safely custody and secure assets, I think this one, even though custody and MPC will continue to be a big focus, how do we start to move money? I think effectively. So
no, that's great. A lot of institutional adoption. There's security. There's some consumer elements, and also consumer uses around payments, etc. So I think I've learned a lot. Thanks a lot for being here. I think this has been very helpful. I think I'm sure a lot of people will find a lot of value in just understanding about valuations in this space and trying to connect it back to their Web2 understanding. So really appreciate it. Thanks
Thank
so
you.
much.
thanks everyone.
Thank you so much. That was an amazing panel. We have 10-minute break, and we'll restart again at 45.